in 10 years, we're going to look back at this and be like, man, not only were the crypto bros right, like crypto, I think it will work, but they've been more right than wrong on everything. And if you take like the expert economist, they should be doing mea culpas. Like you take the best economists, they've been consistently wrong for years. And so don't take like, if I always joke, like the more like acronyms you have around your name and like, you know, suffixes, if you're like an expert in something, we're always learning. We're always trying to get better. But like the people that fancy themselves as experts are going to, in hindsight, are going to look like villains. They're going to be, they're the ones that are co-opted and they're at some big organization. They're just trying to cover up the truth. And like, I like to think of us as artists that are like actually like telling the truth.
Nothing said on the Edge podcast is a recommendation to buy or sell tokens or securities. This content is for educational and entertainment purposes only. Nothing shared here is financial advice.
Welcome to the Edge podcast. I'm DeFi Dad here with Nomadic. Today's show features Tyler Neville from Muddy Waters Capital and co-host of Forward Guidance.
Tyler, great to have you on the podcast finally. I've been a huge fan and listening for, I don't know, probably many years now. I think when Felix came on, that was like a good shift. There's definitely something that the three of you, Quinn, Felix, and yourself, have tapped into on that Friday roundup. So I personally never miss one. And yeah, it's just cool to get you on and you know, pick your brain about macro on our show. So why don't we just get started with, I've never actually heard your background about, you know, how you got onto Blockworks or onto Forward Guidance in the first place. So why don't we just start there?
Sure, yeah. So I spent about 15 years on Wall Street, on first at the sell side and then moved to a bunch of buy side shops, jumped to a couple of hedge funds, a long, you know, asset manager, Franklin Templeton, giant $1 trillion asset manager, an activist fund, a macro fund, and then I got into financial media. So I worked at Real Vision for a year, just kind of interviewing interesting people. You know, I was trying to find like the most divergent thinkers in the world there. And then as crypto started growing, Blockworks was growing and they were looking for someone to kind of help them grow on the macro crypto side as those worlds merged. And that's how I initially met Mike Ippolito and Jason. So I was one of the first, I think, 10 employees there. And I was a moron and gave up my equity when I left for another hedge fund. But it was, those guys are amazing. And, you know, we stayed in touch and they allowed me to come back on and do this Forward Guidance podcast. So that was the whole evolution of it. But now it's growing, and I think people like the fact that we bust each other's balls and kind of are relatively real compared to a lot of the other people out there.
Yeah, totally. And honestly, on that point of divergent thinker that you made, I feel like that's how you strike me with a lot of the stuff that you talk about. And I feel like, so I'm a millennial, and I feel like you've kind of synthesized like maybe the plight of the millennial and maybe even the Gen Z from a macro lens, just kind of what we're all going through financially in these crazy times that we're in. And I feel like whenever you're like really cooking on one of your classic rants, you're kind of always like thinking like, oh, I should probably stop talking now. But that's kind of when I'm like, no, just let him keep going. Let this guy cook. So that's like part of why I wanted to get you on, just to, you know, have you kind of distill some of these, you know, big topics and just kind of let you go on some of them. So some of the things that you mention when you're, again, really cooking on these things is you talk about the boomer Ponzi and why America, the social contract. I kind of want to just throw that at you and maybe just distill where we're at today, 2026. I know that's like a huge, massive question, but like where are we from this like macro geopolitical lens today?
Accountable is the new standard for real-time financial verification. In crypto, financial health still runs on screenshots, lagging audits, and blind trust. But Accountable changes that. Powered by the Data Verification Network, it proves assets and liabilities privately across wallets, exchanges, custodians, and banks. Accountable already secures over $2 billion in verified assets across 115 chains and over 90 data sources. To learn more, go to accountable.capital. Grow wealth exponentially. With Toros leveraged tokens, when the market moves in your favor, your gains become parabolic. They're built to ride trends, auto-compounding profits. With Toros, it's simple. Pick a vault, deposit, and your exposure is multiplied, maintained, and protected automatically against liquidations. Toros reduces risk and keeps you in the market, ready for the rebound. When markets dip, the vaults auto-adjust, softening losses and preserving your position. Just pick a token to multiply your returns. Toros Finance, exponential gains with leveraged tokens. To learn more, go to toros.finance. Neutral is the next generation of crypto-native yield. Their synthetic dollar NUSD taps into OTC arbitrage, funding rate inefficiencies, and delta-neutral strategies to deliver premium, stable returns without taking market direction risk. Neutral is now officially live to mint NUSD and start earning neutral points. Learn more at neutral.fi.
Yeah, let's see where to start on that one. I think one of the things I find most fascinating is like the cognitive dissonance between generations. Like, we clearly know as like millennials, Gen Zers, and younger, that something's not the same in the social contract. Like, clearly there's something different with the inflation in our generation versus the inflation in the boomers. And a lot of the history books that I read, it was like, one was like The Ascent of Money by Neil Ferguson, changed my view on a lot of the stuff. And then there was another one called Lords of Finance by Liaquat Ahmed, where you talked about all the central bankers from the 19th century during these times. And it was really volatile. Like, the world was a lot more volatile when you didn't have like globalism and all the central banks interacting with each other. And that was the norm. So you'd have like much wider swings in volatility and changing hands of assets. And there was, I guess you could say, like more free market in a lot of senses. And when, the boomers took over, it was largely like they opened up globalism. They had like a labor surplus from China that allowed prices to kind of drop for a generation. And that allowed them to kind of do a lot of funky things with the money supply and interest rates and all these other things. So where we are is I think they're trying to stifle the volatility in the markets through monetary policy and fiscal policy so that the system keeps going. But history tells you that's not the norm. Yet we've created this sausage-making factory in asset management and, your 401k. Oh, my target date fund says I'm going to return 6% a year. It's like, the world has never been that predictable. But like BlackRock tells you it is, and John Hancock and all your stupid like financial advisors that have just basically imputed like this number go up for your 401k. But like, the world is massively changing. We just took over Venezuela. Like, the globalism as we know it is kind of breaking down. But we still think, I'm going to make 6% a year in my 401k. Like, that, those two things are orthogonal to each other. And I think that's where, my mind goes, is like, history is way more powerful than just the last 30 years of what we created. It's like finance, dollar comes in, it goes into your S&P fund. Like, that's not the way the world really works. But according to like our financial professionals, that's how it works. And so what has happened is because all of these giant institutions have this incentive of making like 6 to 8% a year for pensions, endowments, et cetera, we've basically manipulated the fiat money supply to get that outcome in the back end. So like, they've promised all the policemen and firefighters and teachers these benefits, and not just them, but all public employees on their pensions. And then they promise certain returns. And so you have to go and you have to mess with the money supply. That's what like the Fed does with interest rates and QE and all these funky acronyms to get this outcome. And so it's a massively controlled scheme to essentially, and what at the end result is you end up bailing out capital owners rather than labor. And that therein lies like this battle, this angst that we're feeling as the next generation is a lot of people in our generation do not own assets. And so they get chopped up because asset inflation's going up, 6 to 8% a year, but our wages are only going up 3% a year. So therein lies like the gap where you have to go out on the risk spectrum in the next generations to actually make up that gap of ownership in certain sectors. So I think that's where we are. Is that helpful in the big scheme of things?
That's kind of exactly what I wanted you to get out. I've heard you talk about that in bits and pieces on forward guidance, but I just think that general worldview, the way you see it, the way I see it too, honestly, is important. And to me, I've heard you guys talk about this. I've heard others talk about this. There's like this suppression of volatility. And then that volatility, I think the wording is like it's been transmuted to other areas of our lives, right? So we're seeing it pop up in all these other pockets. And it's not right. And things aren't functioning kind of the way they should or naturally. You can tell there's forces and coercion just at every point along the way. And it just feels like kind of perverse, the whole system. So
I think we're just starting to really notice it. Like I hate to pump my tires, but I've seen this stuff for a while, and people used to think I was crazy when I'd be like, oh, it's just, there's giant schemes of money laundering. That's just what happens in a centralized economy is you just have massive amounts of fraud. And for the first time, all my friends who used to bust my balls being conspiracy theorists are like, oh, this is actually how the system, as you centralize more and more, when you think about it, it makes a lot of sense where if you're a giant mega corporation, how do you keep growing when you've already grown so much? And the one thing mega corporations do is they just have so much red tape. If you've ever worked at one of these places, it's like to actually innovate, you have to get it through 10 committees, and then you have to get to the CEO, and then you have to pass it through all these other people. So the easiest way for them to grow is not innovating. It's actually just extracting value from different sectors of the economy or different, strata of the wealth economy. And it's usually by just lending more money is how you get that. So that's what I call the short vol trade, is essentially you're just lending debt. That's the easiest way to just create the haves and the have-nots in this K-shaped economy instead of actually innovating. And Peter Thiel talks about this a lot, but that's why for the last 30 years we've been in secular stagnation, is you've had massive centralization in banking, so that when you think about Bank of America, they don't care about the loan they're going to give me as an individual anymore. They need to lend to I don't know, a state or a Apple. They need to raise debt for mega corporations now to move their bottom line. So it's a natural progression in that. But in that big, as you do big business with bigger and bigger entities, there's way more nefarious shit that happens because all the middle managers need to take their slice of skin. And I think that if you're talking about not just corporations, but states, you're seeing what's happening in Minnesota and probably California, we're now discovering that there's massive fraud in there. And it's the only way for people who sustain their living on the public side of things to survive is do these fraudulent things. And it's because we gave up the free market. And therein lies, but my quote is markets have become a political utility. And the only way to keep this game going is you have to suppress the volatility of the bond market and currency markets to just keep the game going. And therein lies the frontier markets are the only places to get the return that stays ahead of the dilution of the currency at this point. That makes sense. Which is what led us all to crypto.
Do you see any light at the end of the tunnel, given all the things that you're calling out that are broken? Is wealth transfer from boomers to Gen X, millennials, Gen Z, and so forth, is that potentially something to, I don't know, level the playing field? And also you called out some of the fraud in the economy. Is there a path forward where that fraud gets rooted out?
Yeah, I think this is the beginning of some sort of enlightenment. Clearly, we're watching Mitch McConnell and Dianne Feinstein, they're barely capable. They're so old that they're going to be out of Congress, and there is a generational transfer that's going to happen no matter what, right? And at the same time, if you're at a centralized giant company and you're not staying ahead of the inflation, your incentive to actually expose the company, it's like this barbell approach where it's like, eventually if you can't keep up with the inflation, you're better off exploiting them and showing all the nefarious things they're doing. So I think that's the point of society we're at, where it's like, if you're internal at a giant corporation, they're doing really bad stuff and you can get a payout as like a whistleblower. We're at this point where I think you're going to start seeing way more. And that's partly why, like, at Muddy Waters, we try to find these companies doing really bad stuff and make them pay for it. Carson Block calls it market-based prosecution. And the problem is that these guys have giant, lawyers, and they're covered. They have all the resources to battle this stuff. But eventually, no matter what, the generational, like, no one wants to work at these companies. They're going to keep rolling over. It's just, we don't even want to buy. Like, I don't even want to bank with my bank because they provide such a shitty service. But you have to, because they're like monopolists. And so when you think about that, just as things evolve, there are new things being built for the next generation that are just way better. And it's just harder to get on those rails. And in 5-10 years, we probably won't even have to worry about it. So there is light at the end of the tunnel. And there's stuff being built now that is just so amazing to get like, I'm not just a pessimist. Like, there's a great newsletter I read called The Rational Optimist. Sorry. And it's these guys that just talk about all the new cool things that are being constructed and great new companies that are being built. And I think that's where the incremental dollar that gets passed down from the boomer will end up at those corporations and not Cable Soup or some shitty, crappy company that has been around for 100 years and does really nothing but buy back their stock and have access to the debt market. So that stuff will happen naturally. I think there's going to be, there may be a period of upheaval. I think if they don't thread the needle correctly, and we're seeing what's happening in the gold and silver markets is like a red flag to me, where things could get derailed really quickly. This is a move that's pretty insane. If you look at silver and gold, and if people start choosing different reserve collateral rather than treasuries, what does that mean globally? If your dollars aren't safe, where do you go? That might happen if the government doesn't figure it out. So, yeah, did that answer your question? Where did I mess up there?
No, I think that was good. I was enjoying that, and I think we should just kind of take that a little bit further. So we kind of asked you to paint the picture of where we are now. I want to try to look, do a bit forward looking. We're freshly into 2026. What is 2026 going to look like with that backdrop? I know nobody can predict the future. It's impossible. But, we've got gold and silver just going crazy. We've got Trump kind of redrawing world maps. We've got AI CapEx build out that's crazy. The news cycle is just nuts. So, with all that, what does somebody like yourself, and I know you can't talk about specific stock names and give us tickers. It's not really what I'm after, but more what sectors are interesting to you, with this backdrop, looking into 2026 and beyond, just kind of knowing or having maybe a rough idea where the puck might be going.
Yeah. So one of the things that the government is trying to stew is nominal GDP growth. So they're basically, whether by monetary policy or fiscal policy, where the government either prints the money or they push it out into the economy themselves, those things will be pushed into sectors that have potential, huge TAMs where the growth could help the economy. So space is one that's really interesting. And I've been talking about this for a while, for years now, and now all the space stocks are moving. But, space, you have to put data centers in space. There's satellites and new Wi-Fi. Why are we using all this infrastructure, like Verizon and AT&T, when you could have, better service from satellites? Like those things there's going to be whole new economies in space. There's one article I read, it was like, you can have light and energy and solar power come from space. And then, you don't even need to do potential power plants. But so there's a lot of stuff in space. There's a whole space economy going on the frontiers. You could say it's overvalued now, but if the government's not allowing like a natural reset of markets, that fiscal push is going to keep going there. AI is another one where I don't know if you want to invest in like the hyperscalers anymore. I think they're the ones taking out massive amounts of debt that essentially are building out the infrastructure. You want to go to the bottlenecks, is like, who's providing the energy, who's providing, the power for AI models. And we've talked about those a lot. There's this battle of centralization and decentralization in, whether it's like Bitcoin power versus, decentralized AI power. That's an interesting place to look at. Nuclear is obviously a huge industry, and the government will tell you what they're investing in. There's this whole Genesis plan that they came up with for AI where they're telling you, we need more power. We're behind China. This is a national security issue. It's the Manhattan Project of our time. And there's only a handful of public stocks that like do this stuff. So I think if you want to stay out of the monetary dilution, that's one industry that should be really, really solid. There's a great paper by this guy, Leopold Aschbrenner, called Situational Awareness, that lays out what's going to happen if AI scales like it should. And that's like mind-blowing, because there's a lot of social ramifications in there. Like, if you don't take part of this growth, you could be, essentially left behind. There's going to be a lot of social contract issues if you don't invest in this. So that's another one. I mean, robotics, there's all the things that are tied in with like a 21st century, like industrial revolution, really is I think where you should be. But all the old stuff that's just hidden in the indices and you don't even know you're investing in it just through your 401k, I think that's toast. Like, they will keep that stuff going, just keeping it up with the dilution of the currency, because they have to, because the whole 401k system is built so like you'll just keep up with, the Joneses by investing in the S&P now. And then forget about bonds. Like, I don't even know why a bond exists. They keep bonds just in status quo. Like, what millennial and Gen Z would ever own a bond when, like, I'm diluting my currency by 8% a year, but with a bond,
I have the same reaction as you. I literally start laughing and I don't even know what the hell they're for, because they're so pathetic, but I know people trade them.
The 401ks are like, oh, your balanced fund. And then you end up investing in like the Austrian 100-year bond at, 0%, and you lose 50% of your money. You don't even realize it. Like, the whole asset management industry needs a rehaul. But because it's so big and bloated, the government has to bail it out. That's my whole premise of like, I say markets are a Ponzi scheme now, is that this stuff is so big and it's really been co-opted. This is what, like, I call it systematic communism, because you've basically created like a systematized funnel for everyone to invest, and it's ruined markets. So the only place there's free markets are in private markets and new ideas, I think. Like, the way things trade on a day-to-day basis, I'm a trader, they should not work like this. Part of it is because you've centralized it. Like, there used to be hundreds of one of my buddies goes to MIT, and he goes, when you have like a really healthy system, there's millions of different incentives interacting, right? And people are buying and selling things in a marketplace for 5 gazillion different reasons. Now you've basically annihilated all the traders in the market. Now they're all done by, algorithms, and everything trades based off the VIX going up and down. Like, the VIX rose today and everything's delevering. And like, that is so unhealthy systemically for everything. And this is going to be probably, when they have some sort of flash crash on systematic investing, everyone's going to go in front of Congress and Jane Street and Citadel are going to be like, oh, why were you 75% of the trading volume? And they were a monopoly, and this shouldn't happen, right? Like, this is the problem of centralization, but the government will bail it out and then it'll just keep going. But the way you stay ahead of it is you have to invest in the frontiers, which is where growth really is. And the government has to force money out into the frontiers. Otherwise the system implodes on itself. So I think that's why our generations are like, I don't, what am I going to buy, a bond? Like, I'm not going to save my way to prosperity when you keep bailing out the boomers, excuse my French, every 2 seconds. Like, they're buying $200 billion worth of mortgages with Fannie and Freddie cash.
You just got to make your coffee at home and avoid avocado toast and you're good. Like, that's all you got to do.
That's the funny thing is, like, boomers they'll ignore, like, what if you want me to make avocado toast and coffee, I will do that. But in exchange, you have to stop bailing out yourselves. You have to stop bailing out your assets in exorbitant numbers. I'll save $5 on my coffee. You stop putting $200 billion in your goddamn housing. Granted, I do own a house and I was lucky enough to buy one. I'm on the front end of this stuff. So I've actually benefited from it. That's the messed up part. But in my brain, I'm like, I still want to live in a social contract with people in my generation that aren't in $200,000 of student loans and can actually function. Like, you don't want this.
You want the world to be fair still. Like,
yes.
You know, if possible, why not?
I get amped up on this, and a lot of boomers hate me, but they never address the continuous bailout of markets. Like, they're always like, well, why don't you just work harder? And I'm like, I'm actually benefiting from it off the inflation of my house and my assets and all that stuff. Most people don't have that. They never had a chance to get up to that point. And even on the hiccup of, like, housing resetting, like, housing affordability is so bad. And his natural reaction, Trump's reaction, is to buy $200 billion more of mortgages. It's like, that's the history of the last, like, 20 years and why people in the next generations aren't having children. It's like, if you let the free market be free, there would have been things would have reset. All the nonsense and fraud would have actually come to the surface. When the tide goes out, you see everyone doing the bad shit. And like, no, that hasn't happened for a good 15, 17 years. So I don't think they can let it happen. So that's why you have to bet on these, you know, in crypto and gold and all these other things, is they keep bailing out the lenders.
You're hitting on all the different, like, landmines that we've seen in our life. You know, there's constantly contradictory type statements being made to us that we need to save more, but we also need to take more risk. We need to just invest in, you know, the most, like, passive indexes, but we need to also, you know, be investing at the frontier. And to your point, meanwhile, the boomers just continually bail themselves out, and that generation has just extracted so much value. There's probably a whole conversation we could have just about the parallels that an investor learns in the crypto markets, because everything is so accelerated and we see so much more on a shorter time frame, but you learn really quickly about monetary policy, and you can then start to apply some of those lessons to what you see in the traditional markets. And then that, of course, reinforces looking for an opt-out and thinking, okay, well, yeah, hold on a sec. Gold didn't perform as well over, you know, many decades against stocks in the boomers, you know, lifetime, but now it's playing catch up because of all the damage they've done. And so again, it's funny to see. I think many of us who are into, you know, digital assets, crypto assets, we've all come full circle. If you didn't understand and value, you know, gold and precious metals, you're really, you know, coming to grips with understanding their value now that we're seeing what we're seeing in, you know, the traditional markets. Like, seeing the sort of volatility, it's just wild. Like, it feels like I graduated college around 2009, in 2009. So that was, like, in the heart of, like, the great financial crisis. And then, I basically just watched one crisis after another since then. And, then we lived through a once in a lifetime pandemic, and I was supposed to long everything at that point because I was supposed to foresee that the governments would bail us out with inflation. And
well, see, this is the interesting thing is if you have the other hard part about investing on the frontiers is the sizing of it as our generation is because the boomers, when you're sitting on a lot of equity, like it's way easier if I'm worth $20 million to hold, a couple $100,000 worth of Bitcoin and ride a 70% drawdown. But if you're worth $100,000, it's really hard to be long volatility assets. They really make you pay for it with the volatility. And so the hard part about our generation is like they sat on houses, which were like low volatility assets, and every policy was made to essentially push the whole tax code is made to push housing values up and up and up along with like banking. That's the backbone of the entire country. And so now you've pushed it to such an extreme where like the gap between generations is so high. But it was easy to hold a house because you had to have your wage pay off your mortgage every month. For us, housing is, not us, but Gen Z generally, where it is now is like, it's really hard to hold a house when, your debt's at say 6% a year on a 30-year mortgage and your wage isn't really going up as much. And so you're like, I'd rather invest in like, something kind of wild and futuristic. It's a whole different like investing game. You can't invest in yield anymore. Like the whole yield, and I think this is where probably getting too high finance, but short volatility and like yield investing, you can't yield the middle class because you have to lend money to get money out of the middle class. And that whole thing is kind of unwinding because the debts are so big on the lower tier now. So the only places to invest are like super futuristic, in my opinion, like risk forward places. The price you have to pay is the volatility. And like every once in a while, you'll get like a credit scare in the old school assets, like housing or private equity or whatever will have like credit spreads widen. And then everything just gets crunched until the Fed says, oh, we're going to lower rates. Or, oh, here's this new facility of like, this is how we're going to bail ourselves out so that we can keep credit spreads low. So that, and maybe that's a little too high finance, but it's just a really tricky. And the other thing is, I don't think you're going to get the same sort of return out of housing in the next 30 years as you did the last 40 years. Because if you think about it, like, our grandparents used to invest in like China, like those plates, and they would be like, oh, you got to get some good silverware because it's a really good investment. And then by the time, we get it, it's worthless. And similarly, the CapEx on housing is going up. There's to be an electrician, like they charge like outrageous rates. Like fixing your house now is exponentially more expensive. So the inflation of owning a house is a lot more. The financing costs are a lot more. It's an aging supply of houses. And not only that, but just like there's not enough like people having kids to fill these things. So I don't know. It's a really weird dynamic of like boomer assets that like extract yield and then the next generation of assets that hopefully grow the pie for the future.
The Mantle Global Hackathon is a 3-month competition inviting developers and founders to design and deploy scalable Web3 and RWA products on Mantle's modular Ethereum L2, built for high performance, low fees, and full EVM compatibility. With $150,000 in prizes and a $30,000 grand prize, now is the time to build. Register by December 31st, 2025. Submissions are due by January 15th, 2026. To learn more, go to mantle.to/hackathon/U4U, and don't forget to follow Mantle_official on X.
Katana is an opinionated blockchain. Its opinion is that for DeFi adoption, there are 2 key things we need: deep liquidity and high yield.
To learn more, go to katana.network. Decibel is the new sound of trading. a fully on-chain trading engine supporting spot markets, perps, and yield to trade global markets. Enjoy trustless execution and sub-penny transaction fees. Join the future of trading at Decibel.trade and access the Decibel testnet today.
When it's come to investing, I've been like, okay, so tech forward for so long and like always trying to invest in tech, whether that's crypto or, Amazon back in the day when I first invested in Amazon. And software too. It's just been, it's crushed a lot of my lifetime. But now we've got Claude Code that comes out and software just looks like it's just going to get eaten every day, right? Like the barrier to entry now for software has just been lowered to almost zero. And I was listening to a podcast the other day with Jordy Visser, and maybe this is like a month ago, but he just said something that stuck with me and I think about it a lot. He was just talking about how this stock, I think it's like Corning or something. It's like they make glass and they're just a big manufacturer that makes glass, and their stock jumped like 2x over like a pretty tight period of time. And, here's me investing in Bitcoin and ETH and like that's just a crazy return from a glass manufacturer. And what does that mean? What does that tell you? It's like, okay, they've already secured power. They have a warehouse that builds something. Even just those attributes, I think, have been like, the market has given up on those things, but they're coming back. Like, this isn't like some new crazy, I'm not dropping any knowledge here, but it's just something that I've been going through. And like, who are people that actually build things that people need? Because that's the stuff that's hard to replicate, not like tech and software, right? That stuff's now a dime a dozen. And we're like reverting back to this older age of like, what can you actually make? What's your output of real things? I actually think that's like an important move, but it's something I'm trying to like just apply to my own investment criteria too. Just like, what is the barrier to entry to the thing that you're making for the world,
Yeah, it's great.
So yeah, that's something I've kind of been like noodling on a bit. But Tyler, I want to kind of ask you, I mean, you can take that if you want to, if you have anything.
I disagree with that wholeheartedly. Is like, if you think about, okay, so just to give an analogy, is what ruined mainstream news was podcasting and the access, right? You used to have all these licenses, and you used to have these giant cameras that there was these access issues, and cost of capital was way lower. And once you had those, you could have your production of mainstream media, whatever. Podcasting, you had the cost of actually filming yourself and putting it on the internet went to zero. And so that created like this amazing supply of media. And so if you think about the software the same way, where, okay, now you have this Claude Code that basically like you used to have to hire a bunch of really good programmers. Now, if that access changes, I think the premium of the multiple of all these software stocks goes down immensely. And what's scary to me is, it's very centralizing. Like whoever wins the battle of the AI, then you become like, all powerful owner of everything. I don't know how they're going to do that.
Yeah,
legally.
you become like Thanos essentially. Like it's
it's kind of freaky. But to that point, I think it's probably the same moment where, okay, some people are realizing, okay, this could decimate an entire industry that we just piled money into for 20, 30 years. And then we're moving, if you think about it, like the Peter Thiel said, secular stagnation was like, we went from touching down on the moon in like 1969 to Woodstock was 3 weeks later. And that ushered in like an era of secular stagnation. And we didn't actually build much. We just build with with bits, not atoms. And I think we're probably moving back into this world of like solving real things like nuclear power, fusion. We're getting there's like SMRs, right? Like small modular reactors. There's things that are really happening now that I think people are trying to discover like real problems, not just like, how can I get my food delivery to my house faster? Like that really, we didn't really, software would mean things a little bit more efficient. There's productivity boom, but this is like stuff that's a productivity boom for everybody, not just certain sectors or strata of the social contract. So I'm so with you there. And I think that's where you got to invest. Like metals there's a huge supply and demand imbalance. Like we didn't invest in digging stuff out of the ground for 15 years because it was hard. Like it was a hard business model. You had to raise a lot of capital and you had to dig into the ground and you didn't know if the resources were going to come out. Like that's like normal investment, and things were so easy from a software perspective for so long. I think that whole thing is changing, and there'll probably be new giant organizations coming from this, from what you said.
As crypto investors, I think we all tend to pay attention to, just the usual. Is the Fed going to cut rates, or are they going to keep them flat, or are they going to raise rates? We've lived through years of them raising rates until more recently. There's just been all sorts of mental gymnastics there that we've done over the years. Cutting rates would ultimately lead to cheaper money and all of the tokens would go up. And I think we're now at a point where the whole digital asset landscape has matured to a point where we're actually seeing a smaller subset that are actually thriving. To bring it back, though, to interest rates, what's the simplest way to dumb down what you pay attention to? How does that factor into your mental model for betting on the crypto markets? Like what makes sense anymore to you in terms of interest rates?
Well, there's definitely like a transitional period with crypto. Interest rates, I think, if you just I look at the MOVE index, which is bond volatility, and this is what governments try to stifle. Like as long as bond vol and FX vol is low, they're it's like a software. If you think about central banking as a software, they've kind of figured out the software where like they need to keep creating more and more debt and keeping this Ponzi scheme going. They need to keep bond volatility and FX volatility low, right? They need to keep all the trading cross currencies in some simpatico where, most countries are fine. But every once in a while, like why we're seeing some bond volatility now is Japan is essentially lowering taxes. They're, stewing growth for the next generation, and their yields are rising globally. And Japan was ground zero for like the giant debt bubble the first time around. So now they're changing policy, and it's a generational change. Like, now they're trying to force growth into their economy so that the next generation can it's what's probably going to happen here eventually too, where you have to force nominal growth, but then your bond market gets wonky because what's the point of owning debt if you're just going to let your currency kind of go implode, right? So this is like, it's a slippery slope globally, but I think when you see bond volatility rising or yields rising really fast, that's a really big concern where I think you get a drawdown in assets because that flows through to equity, that flows through to crypto. And it's kind of what we saw today. But it all hinges on interest rates and global interest rates. The funny thing is most people just pay attention to the Fed, like blah, Fed, but like things are so integrated now that you have to pay attention to the PBOC, you have to pay attention to Japan, you have to pay attention to Europe and where all those capital flows are coming from now. And there's a great guy, Capital Flows on Twitter who does great work on this stuff. Michael Howell follows it as well at Cross Border Capital. But that's I think at the end of the day, they're gonna just they're gonna stifle it because then they can't pay out the pensions. Like they will eventually do it, but then they almost have like a month-long span during the year where they act like the markets are free and let everyone get scared before they bail it out again. And so you have to be one step ahead of the politics now. And that's looking at, bond vol, equity vol, FX vol, and, crypto vol now too.
As a DeFi investor, I turn to Maple for permissionless institutional quality yield in a single liquid asset backed by over-collateralized loans. Maple's Syrup USDC and Syrup USDT are now supported as collateral for enhanced yields on major DeFi liquidity hubs such as Pendle, Fluid, Camino, Jupiter, Morpho, and Aave. To learn more about Maple, go to maple.finance. Hey folks, I want to tell you about our sponsor, Gearbox, the protocol that reimagines on-chain lending. With Gearbox, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about Gearbox, go to gearbox.fi. Puffer Institutional delivers secure, high-yield Ethereum staking built for institutions with battle-tested security, granular access controls, and the ability to boost APY by securing multiple AVSs. Puffer gives institutions full control and optimized returns. Puffer is also behind the Unify-based rollup, aiming to transform Ethereum's future in a world where all L2s are working together. To learn more, go to institutional.puffer.fi.
Tyler, there's so many things I want to ask you about, but I definitely want to get you out of here on time as well. You mentioned Michael Howell in there, and I was kind of shocked to see that he thinks liquidity is topped, I think, and I think he's not very optimistic for liquidity in 2026 from what I've gathered. It's kind of, I think, flies in the face a little bit of what I've seen others saying, but I kind of think of him as the expert. I know it's like very nuanced, but we could get into that, but I think I want to wrap with, we probably haven't talked enough crypto on this crypto podcast.
Yeah.
So
Sorry.
I want, no, this has been great because all we do is talk about crypto, right? So this has been a refreshing kind of macro break for us. And this is ultimately what we wanted. But I want to kind of end off on kind of your views on the strength of gold and silver throughout 2026 and also your view on Bitcoin through 2026. And then throwing a lot of questions at you, but what conditions sort of need to happen for Bitcoin to make another major move in 2026 or just whenever?
Yeah, I thought last year, well, on gold, I think it's just a secular play. Like you're watching the world break apart. I think that's what gold is telling you is like for 40 years, you saw when you were a exporting nation like China, we would buy their goods. They would take that money, they would go buy treasuries with, the dollars that we sent back to buy their goods. Saudi Arabia, we would buy their oil, they would buy our US treasuries with that money or assets. Like that petrodollar recycling or when export dollar recycling, that was normal forever. And now China's, I think, taking that export dollars and they're putting it in gold and silver. And Russia is doing the same thing where one of the biggest fumbles probably in hindsight was when Biden essentially repossessed all the Russian assets. And that moment, that wasn't, you get why he did it, but that sends a signal to all the other countries that U.S. is no longer just this free market where capital flows can go in and out as you please. And that set off, I think, the gold bull market. Was that moment. In hindsight, it's pretty obvious that's what happened. Does that keep going? Yeah, like there's certain parts of the world like the China influence. They're such a manufacturing powerhouse that any incremental savings dollar is going to go into precious metals from here on out. Is my read. There's a massive supply and demand imbalance. How do you save yourself from all this fiat, global fiscal super cycle printing? That's one way out. I do think Bitcoin will react eventually. There was a lot of tax loss selling. There's a lot of funky things market structure wise. I think the treasury companies, there was a lot of funky over raising. They had a multiple on all their holdings. That's all reset. I think we're getting to some sort of weird equilibrium here. And now if you get some impulse of liquidity higher, it should still kind of rock, but there's been a lot of funky things idiosyncratically in Bitcoin. But the funny part is also it's not even down that much. Over if you look at like zoom out, it's still at $90,000. Like we're just expecting it to. The problem was it didn't do what gold is doing, right? Like that's what everyone thought. It's the same thesis, but I think eventually it will. I would love DeFi to work personally. I think they need a better marketing pitch. There's a lot of people that they raised a lot of money and they're not really creating anything real. there's a lot of nonsense. I would talk to these people and I'd be like, can you tell me what you do? And they can't tell me in simple words what it's like, some weird abstraction of like, I mean, I'm sure what you're doing is brilliant, but like you can't simplify it. And what DeFi to me should have been is just, you have a high yield. So you have a treasury bond, right? That yields 5%. You got a high yield bond that yields 7%. And then you have DeFi yield, which should be, 15%. That should be like the out of the frontier where you manufacture yield. And that's what gets pensions involved, because they need to buy the debt. Like Aave makes so much sense to me, because it's like, here's this, you can have it's just a new banking system. But I don't know. We'll see if that actually comes to fruition or not.
It's funny you mentioned that. We're doing a mini series within the Edge podcast called Revenue Meta, and we're looking to just interview, the most mature DeFi protocols like Aave, or recently we did Maple, we just did Pendle. We're just trying to get those answers. What do you do? How do you make money? How does that return value to token holders? And what's funny is the markets are ready for this. DeFi is ready for this. I think what we're dealing with is the aftermath of so much shit getting funding over the years, and this assumption that if I just create a protocol around some sort of value prop, and then I issue a token, and that token is used to decide on future upgrades of the protocol, then the token is going to be valuable. And the market has totally repriced that and, shown us that they're not. A lot of them are not worth that.
Like the one thing that's DeFi makes so much sense to me is it should have just been a capital raising mechanism. Like if you have an idea and you can raise capital really fast and get rid of all the red tape that you need to IPO, and someone believes in that idea, that's actually the access thing. They should be pitching that regulatory wise. It's like, this is a quicker, faster way to raise capital. It's a little more dangerous, I guess, but that should be the use case along with yield. And you'd have a whole new banking system. But I don't know. Maybe I'm the dumb macro guy and I don't get it.
Hey, to wrap up on this, in order for Bitcoin to go to that new high that we all want to see, we need that next mega bid. Who's the next biggest buyer? One idea I had, and I'm wondering if this is top of mind for you at all, is, we had the spot ETFs, most notably for Bitcoin and ETH. Those have seen a tremendous amount of inflows, tens of billions of dollars, and that can continue to, create an enormous bid for ETH and Bitcoin. But I'm thinking more along the lines of the Department of Labor, I believe, rescinded this guidance for fiduciaries to basically be cautious of putting crypto into retirement funds. And as far as I know, retirement funds in the U.S. represent $44 to $47 trillion. Is this potentially a huge catalyst for, major buying of at least Bitcoin and ETH? I'm calling those two out because they're the two largest spot ETFs. Does that register for you, for someone like you with your expertise?
Yeah. I mean, to go back earlier, is if bonds don't make sense, and then you got to go to other stores of value, or it makes way more sense to me than owning a treasury bond. Parking my money in a treasury bond right now is just, it's like lighting your money on fire. But there's mandated things for why it's happening. So mandating, eventually they'll probably mandate a 1% allocation or whatever it is. And that's probably a huge amount of money that could flow into Bitcoin and ETH. I think the president, he's also behind this. I think there's a lot more people behind this, because it really helps. If you look at it from a geopolitical perspective, you're going to have the Chinese-led gold world, and then you're going to probably have the crypto-led, U.S. world, and you're going to have to choose which world you want to be transacting in. And I don't know. I think you might have to force that policy lever, but right now I think they're cutting off a lot of the funding for I think the legacy banking cartel is so strong that it's really hard. These things are so political. Like it's political and generational, and eventually it'll go to the better technology, I think. But I can't tell you when that is. You just gotta you gotta have stop losses in my rate. Like when price isn't cooperating, there's a reason why. And I don't take 70% drawdowns and just hodl. Like I usually, psychologically, and then I get back in if it, if a stock trades between 9 and 10 and then it breaks 9 for a considerable amount of time, that means like there's a whole new set of sellers out there for some information that you don't know, right? And vice versa, when it goes through 10, you also know like there's a new set of buyers in that marketplace that, it when it traded in that band. So I don't know, when it starts breaking out to new highs, that there's something coming. I bet if you get through 100K again, my bet is there's some legislation or back office, behind closed doors stuff happening. Like you said, it's going into 401ks, or it's, they're going to open up the access for banking. So those are the things. Right now, we're just in this weird, we're not really breaking any lows. We're not breaking highs. And I think that's what's torturing crypto investors.
Yeah, the banks wanting to prevent access to stable coins with yield or stable coins that offer any sort of reward, that just seemed to become a major narrative with the Clarity Act basically falling apart. And so, yeah, I think you've given a lot of insight into there is a legacy world there that still really does not want crypto and DeFi to work. They see it as competition, but then they're almost trying to co-opt the space. And I mean, this is part of the reason we do everything we can to stay long over the long term, whether or not you're selling out of, ideally the top of a cycle and trying to buy back the low. Still feels like there is room to run. I mean, this space is still only a few trillion on its best day. I think 3 trillion was the high that we hit this cycle, and feels totally mispriced for what could rewire the back end of finance. But Tyler, this is probably a good place for us to start to wrap up. I appreciate you staying longer with us than expected. So just quick reminder to our listeners, if you want to learn more from Tyler, you should follow him on Twitter. His handle is Tyler_Neville_. Follow Forward Guidance as well. Probably are familiar with Forward Guidance, but go there and you can find the links to the podcast and enjoy more of his takes on the podcast. And then Tyler, just again, thank you for joining us. And what an epic day to have you on, and just appreciate you coming on with us. But any final word here before you go?
No, thank you guys for having me. And I think, as pessimistic as I sound, I think there's some green grass coming for all of us, as these generational things change and we move from the fourth turning to the first turning. And I think we're rewriting a lot of, if you actually talk to people in our generation, everyone's kind of on the same page, even though, you go on mainstream media and it's politically divisive. Everyone's kind of adding it up. And I think in 10 years, we're going to look back at this and be like, man, not only were the crypto bros right, crypto, I think it will work, but they've been more right than wrong on everything. And if you take the expert economist, they should be doing mea culpas. You take the best economists, they've been consistently wrong for years. And so don't take if I always joke, the more acronyms you have around your name and suffixes, if you're an expert in something, we're always learning. We're always trying to get better. But the people that fancy themselves as experts are going to, in hindsight, are going to look like villains. They're going to be, they're the ones that are co-opted and they're at some big organization. They're just trying to cover up the truth. And I like to think of us as artists that are actually telling the truth. So that's where I'll leave it.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.